Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica, and here are the top stories in crypto this week. SEC sues Consensys. The anti-crypto regulator goes after one of the largest crypto companies, foreshadowing additional crackdowns. Which crypto projects is the SEC targeting? Ethereum ETFs delayed. Just when everyone thought ETH would get its God candle, the SEC kicks the can down the road yet again. Why asset managers could be to blame. Solana ETF filings. Asset managers VanEck and 21 Shares apply for spot Solana ETFs in a surprise move that sends Sol soaring. What will it take for approvals to happen? Peter's price prediction. Billionaire entrepreneur Peter Thiel predicts that BTC's price won't go much higher from here. But how much higher could BTC go? US sells BTC. The US government sends almost 4,000 BTC to Coinbase, reminding everyone that Uncle Sam has promised to sell 40,000 BTC last year. Everything you need to know. Mt. Gox Repayments. Megabank JP Morgan predicts that BTC's price will be suppressed in July as Mt. Gox creditors reclaim and sell billions in BTC. When could the price recover? And a closer look at last week's top performing cryptos and where they could be headed next. All this and more in just a moment. Last week, the SEC sued Consensys, one of the largest companies in Ethereum's ecosystem. The regulator is alleging that Consensys violated US security laws with MetaMask swapping and staking services. This is surprising and not surprising at the same time. It's surprising insofar as Consensys had given everyone the impression that the SEC would not be pursuing the company over matters related to Ethereum 2.0. As we noted in last week's crypto review, this very specific wording suggests that Consensys could still be sued by the SEC over something else. Well, here we are. Anyways, it's also surprising because the judge in the SEC's case against Coinbase had effectively rejected the regulator's allegations against the Coinbase wallet back in March. Given that MetaMask is analogous to the Coinbase wallet, it is surprising that the SEC is trying to go after Consensys over it. On the flip side, the SEC's lawsuit against Consensys isn't surprising, given that it is similar to the ones it has levied against other crypto companies and projects. In other words, the SEC clearly takes issue with everything DeFi, so it's not surprising that it went after MetaMask's features. Case in point, the SEC referred to Lido Finance's LDO token and Rocket Pool's RPL token as securities in its lawsuit against Consensys. This underscores the regulator's anti-DeFi stance and could foreshadow additional lawsuits against these liquid staking protocols. The silver lining is that the SEC's case against Consensys is actually a nothing burger. This is due in part to its similarity to the SEC's other recent lawsuits, and in part because it didn't contain any information that would be damaging to Consensys or the Ethereum ecosystem. That's why ETH didn't move on the news. By the way, if you're enjoying the video so far, be sure to smash that like button and subscribe to the channel and ping that notification bell so you don't miss the next one. Now, by contrast, ETH did see a bit of a pullback over the weekend when it's revealed that the SEC had essentially delayed the spot Ethereum ETFs yet again. This can be clearly seen on the ETH BTC chart, which shows that ETH fell quite sharply against BTC after the news of the delay hit the wires. To bring you up to speed, the spot Ethereum ETFs received the first of two approvals from the SEC in late May. The second round of approvals required for the actual listing were expected by the 4th of July, this Thursday. However, the SEC is asking ETF issuers to submit more documentation by the 8th. Logically, this suggests that the spot Ethereum ETFs may not be listed until sometime later this month. Believe it or not, this may not be the SEC's fault per se. Rather, it is possible that the spot Ethereum ETF issuers are working with the SEC to delay the second leg of the approval process so that the listings themselves are delayed. This is simply because the market conditions aren't optimal for a listing. In case you haven't noticed, the spot Bitcoin ETFs recently experienced enormous outflows and are now experiencing minimal inflows. More importantly, investor interest in crypto appears to be extremely low, particularly among retail. Seeing as most of the spot Bitcoin ETF inflows have come from retail investors, this means that listing the spot Ethereum ETFs would now be basically guaranteed outflows, particularly from Grayscale's spot Ethereum ETF. Recall that this happened with the spot Bitcoin ETFs due to the trust conversion. In turn, this would result in a bad look not just for the asset managers, but also for Ethereum itself. Imagine the headlines. Spot Ethereum ETF flop proves that ETH is old news and that institutions are now obsessed with Solana. That's the kind of headlines we'd likely to see if the ETFs launched now. If this is the case though, and that's a big if, then the spot Ethereum ETFs could be delayed indefinitely, just like the Fed's rate cuts. Lo and behold, sources told Crypto Media that there will be, and I quote, at least one round of filings, implying that this will be the first of many delays to come. In turn, this could mean more ETH weakness against BTC and potentially in fiat terms too. If you want to make the most of these moves, be sure to check out the CoinBureau deals page. It's got trading fee discounts of up to 70% and sign-up bonuses of up to $100,000 on some of the best exchanges. The link is down below. Anyhow, while the spot Ethereum ETF shenanigans were going down, Van Eck and 21 Shares made the surprise decision to file for spot Solana ETFs. This is surprising because the SEC has referred to SOL as a security in its lawsuits against Coinbase and Binance, something you'll know if you watched our summary of the lawsuit against the latter. It's also surprising because it seems to be inconsistent with the spot crypto ETF approval process that we've seen for BTC and ETH. To refresh your memory, BTC and ETH first listed on the CME Futures Exchange. Then, these CME future contracts were used to launch the futures BTC and ETH ETFs. And this resulted in the SEC eventually approving the spot BTC and ETH ETFs. While future spot crypto ETFs may not be needed to go down the exact same pathway, filing for spot Solana ETFs still seems premature. As many crypto analysts have pointed out, the SOL ETFs likely reflect the belief that a change in US administration would result in crypto rules that allow them to list. This is something that was pointed out by the Bloomberg ETF analyst Eric Balkunis, who also highlighted the fact that the filing for SOL ETFs now means that the SEC will have to make a final decision on them just after the November election. This would make them the first approved if change does come. Regardless, the filing of the spot Solana ETFs is significant because it suggests that institutional investors are seriously interested in crypto besides BTC and ETH. Although SOL may be the crypto that we've heard about the most, there seems to be equally large interest in the likes of Avalanche and Deepin projects. Note that you can learn more about which narratives will be the biggest during the crypto bull market using the link in the description. On that note, BTC's sluggish price action has had many wondering whether the traditional 4-year crypto bull market cycle is dead. It's safe to say that billionaire Peter Thiel stoked these fears by noting during a recent interview that he's not sure whether BTC will go up dramatically from here. Peter said this is just because the spot Bitcoin ETFs listed, and it looks like all of the buyers who are waiting on the sidelines have already bought. In the absence of new buyers then, it's hard to see how BTC's price could continue to increase as much as it has historically. If you watched our recent video about where we are in the crypto cycle, you'll know that BTC has experienced diminishing returns over time. However, you'll also know that institutional investors still expect BTC to hit around 160K, sometime this cycle, which is still an objectively sizable gain. In the short term, however, Peter is still objectively correct. All the buyers that wanted to buy in have already bought, and in the absence of new buyers, BTC's price is unlikely to rise dramatically in the short term. In the longer term, more investors will get involved as regulatory clarity improves around the world. It's easy to forget that most of these spot Bitcoin ETF flows have been driven by retail. Relative to retail, institutional investors aren't that involved in crypto. Besides the lack of regulatory clarity, higher interest rates mean that for the first time in a long time, there's an alternative to investing in volatile assets. Large investment firms like Berkshire Hathaway are literally earning billions by just holding US government debt, which is, ironically, somewhat volatile. In any case, as with 4-year cycles, history suggests that there will be a need for fiscal and monetary stimulus at some point. Whereas the fiscal stimulus will reawaken retail investors, monetary stimulus will reawaken institutional investors. There's no telling when either forms of stimulus will come or what exactly they will look like, but most would argue that it is inevitable. Inflation is the only way to get out of the global debt bubble. Speaking of global debt, most of you will know that the US government is almost $35 trillion in debt and counting. Some would say that it would be wise to hodl some hard assets like BTC or gold in such an environment, but it seems that the US has opted to sell off these hard assets instead. I'm, of course, referring to the US government's recent sale of almost 4,000 BTC, something that was quickly caught by on-chain analytic firms. The US government sent this BTC to Coinbase, presumably to sell. You might remember that the German government has recently been selling BTC too. What you may not remember, however, was that the US government had promised last March to sell over 40,000 BTC that it seized from the Silk Road darknet marketplace. Interestingly, the US government had only sold around 10,000 of this BTC last year. Earlier this year, it was caught moving the remaining 30,000 BTC. What is fascinating is that the 4,000 BTC recently sold was an entirely different stack related to an entirely different case. This is fascinating because it means that the US government is probably still sitting on the remainder of its Silk Road BTC. This begs the question of when it could sell that, if ever. As with the German government, it's impossible to know when the US government will sell its remaining BTC. But the fact that it hasn't done so yet suggests that it believes there could be a better day to do so. In plain English, the US government maybe isn't dumping BTC because it thinks its price could go higher. Even so, the recent sales suggest that both governments believe this could mark the local top for BTC. Notably, the fact that most of this BTC was sent to exchanges suggests there is a shortage of OTC buyers. This brings us back to the point I made earlier. The crypto bull market is still in its early stages. And this brings us to what is arguably the most important crypto factor this month, and that's the return of BTC to Mt. Gox creditors. For context, Mt. Gox was a crypto exchange that collapsed way back in 2014. Since that time, creditors have been trying to reclaim the 142,000 BTC that wasn't lost. Over the last couple of years, there have been multiple reports that this BTC was about to be returned, and each time the crypto market dipped on the news. Obviously, the reports turned out to be incorrect, and the crypto market recovered. Well, it looks like this time it could be for real, and it could result in real volatility. To put things into perspective, 142,000 BTC translates to roughly $9 billion. It goes without saying that not all Mt. Gox creditors will sell, but some will. Consider that BTC is up roughly 100x since 2014. That's going to be a massive payday for the 25,000 or so Mt. Gox creditors who've waited over a decade to be made whole. Again, it's impossible to predict how much BTC will be sold, but let's use the good old 80-20 rule and assume that 20% of the 142,000 BTC will hit the market. That would translate to roughly $2 billion of sell pressure, which is roughly equivalent to what BTC experienced when it recently fell from 70k to 60k. If we assume a similar level of market depth, which is debatable, then BTC could fall by another 10k to around 50k. The caveat is that lots of whales have been buying up around 60k, but the catch is that there's also lots of traders going long around 60k. This will result in liquidations that would also push BTC lower. The silver lining in this case is that this would likely be the final correction BTC sees before blasting off to new all-time highs. According to JP Morgan, BTC will likely start recovering in August. We reckon the altcoins will lead the recovery if there's a rate cut between now and then, which also could happen. With all that said, it's about time we looked at last week's top performing cryptos. So last week's top performing cryptos were Casper, Dog with Hat, Aave, Akash Network, and Avalanche. Starting with Casper, its KAS coin appears to have pumped on the news that Marathon Digital, a publicly traded Bitcoin mining company, has mined $16 million worth of KAS as part of its operations. As you can see, KAS appears to have invalidated that head and shoulders pattern that we spoke about last time we covered the project. However, it appears to be approaching the upper trend line of its recent price range. If the crypto market keeps weakening, it will likely get rejected. Next up, we have Dog with Hat, which appears to have pumped on the news of the spot Solana ETF filings. For reference, WIF is a meme coin on Solana. As you can see, WIF's recent rally barely registers on its long-term price chart, and it looks like it's headed for another leg lower. As for Aave, its Aave token appears to have pumped due to the 2030 proposal being passed. For those unfamiliar, the 2030 proposal includes a series of upgrades to the DeFi lending protocol, including cross-chain liquidity and non-EVM deployments. As you can see, Aave's price chart is similar to WIF's, in that it looks like it's going to keep rolling over. Note that this is going to be the case for most cryptos if these sluggish conditions continue. When it comes to Akash Network, its AKT coin appears to have pumped due to the news that it had listed on Coinbase for New York residents. We honestly had no idea that New York residents had such crazy restrictions around crypto listings. That is really unfortunate. What's even more unfortunate is that, like WIF and Aave, AKT looks like it's going to keep rolling over. Just keep in mind that there could be another surprise rally if there's any bullish AI news that does come out. Well, finally, we have Avalanche, whose AVAX coin appears to have pumped on the news that Chainlink had added data stream support for its Layer 1 blockchain, starting with the GMX derivatives DEX. As you might have guessed, AVAX looks like it's going to continue to keep rolling lower after its recent head and shoulders pattern. This could be a good accumulation opportunity for any AVAX bulls in the crowd, not financial advice. Note that you can also keep track of which cryptos are pumping and also where you can trade them by joining the Coin Bureau Insider Telegram channel. The link will be down in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too. Don't forget to check out our deals page, where we have massive trading fee discounts and sign-up bonuses of up to $100,000 on some of the best exchanges, only for the viewers of this channel. Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has you covered. You can find the link to those resources and many others in the description down below. Thank you all so much for watching, and we'll see you all in next week's episode. This is Jessica signing off.